Hey, welcome back to another video. It's been a while. So, a little update. We hit our goal of six figures in the portfolio not too long ago. Right now it's almost middle of August, and I got to a certain point where I thought to myself, you hit six figures, you hit 100,000 in your portfolio, and you realize, hey, there's a lot of complacency, right? That's just me. Now, I very well could have just continued on and said, oh, now we're going to go to, $250,000, like the next goal, and then from there on out. But I felt like once you get to a certain point in your portfolio, you just think to yourself, like, wow, you like every time you keep investing, it's like the brick is a little bit smaller. When I first started the challenge and it was something like over $27,000, if I was investing $1,000 a week, I was looking at like over 3% of my portfolio being invested every single week. But then I realized that at a certain point in time, once you get to six figures, you're investing, let's just say $1,000. That's 1% of your portfolio. So I decided I need to start over. And I don't understand why Robinhood does this the way it does this. The way it calculates like your gain and loss when you do an account transfer and when you withdraw money from the account. So this is clearly not correct, but we're going to disregard that. We're going to say the starting value was $1,200, give or take. Last couple days ago, we had our initial investment go through for it was $1,000. I want to say it was $1,000. 1, 2, 3, 4, 5, 6, 850, 950. Yep, 1,000. So I went on quite the shopping spree, and as adding on to that, I asked my little Twitter community if they would recommend a few stocks that I might take a little bit of interest in, to start over on this portfolio, because my belief is that every time you start out, again, you might want to change something, you might want to start something new, and it's all part of the fun process. If you're not having fun with it, you're probably not investing properly. There has to be a level of fun involved, in my opinion. So last time around, just to give you a little bit of background, I was very Apple heavy. I think it was like 45% of my portfolio, very tech heavy. I think Nvidia, 10% of my portfolio. Amazon was like 10%. Tesla was something like 8% of my portfolio, and then so on. And then Spy, I think, was like 5% or 6% of my portfolio, something like that. And I figured now I want to be a little bit more on the defensive edge or the defensive end. However, though, I don't want to be too defensive. We're investing heavily into dividend stocks to where these are like the type of dividend stocks that are like on a losing streak. You look at them 5 years a day and they're like down 20, 30%. I'd rather take a lower dividend, but it has, significant growth. It holds its weight well. It has good fundamentals. It has a healthy balance sheet. I like your level of leadership, all things considered, right? So the two stocks that Twitter recommended, and I looked into, and I couldn't really disagree, was Shopify and Berkshire Hathaway B. So it's pretty self-explanatory. Shopify had a great run up during COVID because e-commerce was just exploding. Same thing with Amazon, and then it basically lost a lot of its gains, basically all of its COVID gains. Same thing with Amazon, right? Pretty identical there. And no, I didn't get in like when it was $26 a share, but I figured now would be a great time to get in because I do want to believe that this has a lot of long-term potential, especially with the whole e-commerce factor. And it does seem like it has a healthy balance sheet for the most part. Its fundamentals seem there. And I feel like now it has a lot of attention on everyone's radar who, might be investing into, an e-commerce, point of contact, website, whatever you want to call it. And especially if you're looking at something like this compared to Amazon, would you rather want to spend $140 on Amazon a share or $55 on Shopify? To me, price isn't too much of a concern unless you're looking at the Berkshire Hathaway Class A shares, not spending $500,000 a share. But when you look at the fundamentals and you look at the level of return, I think it's extremely important to look at that and compare it. Now, Shopify could very well have substantial growth in the next couple of years at $55 a share. It could be a little bit more stagnant compared to Amazon. It has not that much built up reputation compared to Amazon. It's a little bit newer than Amazon. So there's that. And on the other note, Berkshire Hathaway Class B, I mean, I think it's pretty self-explanatory. When I saw Berkshire Hathaway post their earnings, this was like however long ago, it did fairly well. The growth, the bump up. Hey, great! It seems like there's a great level of support here now. Now that Berkshire Hathaway reported tremendous, I think it was operating profits. And on another note, they had like a record 150 billion cash pile, which to me is just mind-boggling because that amount of cash is worth more than most companies like market caps. I think that's around the same amount that Apple has in their cash pile. Could be more, if I'm not mistaken. But at 350 a share, I don't think this is an entirely expensive stock, considering that if you look at how much growth it's had in like the last couple of years, you're not looking at like too much growth. I mean, shy of 75% growth, yes, that's good. Last 5 years, and most of that is because of COVID. But real estate tends to hold its value fairly well. And what I do like a lot about this stock, and if you do know me, I am a big fan of stock splits. Now, however many years ago, you know, Berkshire Hathaway did split. They did do their stock split, and this was back in 2010. They underwent a just one stock split, and basically it was like a 50 to 1. That's pretty much it. So, let's just say it was $100 a share. Now it's $2 a share, and you have 50 shares essentially. So, 50 shares. That's an insane stock split. But I think at the time it was over $2,000 a share, if I'm not mistaken. So I do feel like now looking at this seems to be a little bit more defensive, especially it's real estate. So it's a great place to put your money. That's just my own personal opinion, and just kind of not beating myself up over the fact that I didn't hop on this sooner. But that's a lot of stocks. You could look at other stocks and you might have missed out on it, and you just have to stick to your guns and know that hey, this is gonna work out for me in the future. But if you didn't get on in the past, get on it now, type of thing. I do like their price to earnings ratio. That's very favorable. It's not like, be honest, you look at Nvidia's, and a lot of people are very concerned with Nvidia's. Like, okay, 212 price to earnings ratio. That is very sketch. But I do believe in Nvidia. I do think there's a correction inbound, considering how much it's grown in just the last year alone. And we are starting to see, a nice, healthy sell off with it long term. Another reason as to why, like I mentioned before, stock split. I'm a big fan of stock splits. Once you get in prior to that stock split, I mean, all a stock split is like a psychological, I wouldn't say a trick, but it's just all psychological to entice the investor. Like, hey, you're getting more shares, but the price is being decreased, right? They're increasing the amount of shares outstanding. And I think that's a valuable way of pricing a stock for long term. Apple and I believe Coca-Cola have, and Oracle, a couple other tech stocks have some of the best histories of stock splits. And I'm betting big long term on these tech stocks splitting because most of my shares that I own now have stock splitted. Shopify is stock split 10 to 1. Nvidia, they stock split 4 to 1. Tesla stock split 5 to 1, and then 3 to 1 prior. Amazon 20 to 1. Apple recently 4 to 1. Merck has not. Shopify 10 to 1. Berkshire 50 to 1. So all these considered, as long as you get in on these, prior, and you have like a substantial amount of growth, and you can build up a healthy amount of volume to the point where they split, you'll be seeing a lot of volume, which is actually great. And I don't know if we'll be seeing any stock splits anytime soon. I would like to say that if there's any stock that will most likely split anytime soon, it'll probably be Nvidia, considering how much it's run up. It gets to a certain point where prior, when it was like $800 a share and it's split, it was like, well, actually, pre-split, this would be over $1,200 a share, considering, hit like 330 and it had a 4 to 1 stock split. So, and right now, if it was pre-split, you're looking at like over $1,700 stock split. I'm trying to do quick math here. Don't judge me. So that's absolutely insane. And a company like this, I just know as a fact, sometime in the near future, they're probably going to stock split again. And I do own a significant amount of shares of Tesla that I transferred over, and I am betting big on Apple as well that they will be stock splitting. I'm pretty stoked about that for when the time comes. Prior to when I did my low account transfer, I sent over 220 plus shares. something around that amount. And all you need when you get to like that amount of shares is like a 2-to-1 stock split, a 3-to-1. Nothing too high, nothing too outrageous, but I would be happy with a 3-to-1, even a 4-to-1. I know I might be asking for a little bit much here, but Apple, I don't believe is going to be splitting anytime soon. We may see Apple split when it gets like the $300 or $400 range again. I don't know. At that point, they might say, "Hey, 2-to-1 stock split or 3-to-1." And at that point, I hope to be building up a lot more shares of Apple to the point where I can maybe take my foot off the gas pedal just a little bit and let that amount of volume work for me. You know, my goal is to build up eventually one day 1,000 shares of Apple, and if you look at that amount as it is right now, you're looking at over $177,000 at current trading price. So I am on my way to that, and on another note, I think one of the reasons why it is most humbling to start over in a portfolio like this with four figures is that you're not. I don't really find it any joyous feeling to brag about a portfolio. I do this to try to like raise awareness, like, hey, this is my journey. This is what I invest in. It's fun for me. I don't show people the portfolio value. I mean, you can clearly see it, but for the most part, I like to show like what I invest in, like to stay a little bit transparent on that note and say, hey, this is like what I've been investing in. This is what works for me and what doesn't. Hopefully, it can move someone a little bit to say, hey, maybe that might be a good investment. Maybe that might not be a good investment per Joe because it hasn't worked for him. But at the end of the day, it's just my own personal opinion. It's not financial advice. It's just what works for me and what doesn't. But yeah, now we're back on the road to six figures, and I figured once we hit that amount again, whenever that will be, I have no idea when. We'll definitely have to regroup and rethink maybe another possible investment that could give me a different type of idea or light onto how to proceed with my portfolio. But as you can tell, I am a little bit more defensive now. 250 is being invested into SPY as opposed to 100 for the other tech stocks. And a lot of people disagree with my investment strategy. Hey, you're very tech heavy, Joe. You should be investing in like consumer defenses like PepsiCo, Coca-Cola, I don't know, real estate stocks. That's just never really been one for me. I can take the brunt of a sell-off. I have very high risk tolerance. I could see a 60% sell-off and I'd be fine. I would buy the dip. But now that I am extremely tech heavy and I transfer all those shares over and whatnot, I look at this and go, I want to have a little bit of fun with this, but I want to build up a little bit more of a defensive portfolio because, if you look at the NASDAQ, right, it's done extremely well during COVID, right? And even year to date, it's still up over 31%. Think about that for a second, 31%. And we're not out of the woods yet compared to its high, which was about 16,000, where it bottomed out. It was 16,000. It bottomed out over 35% plus, right? And now it's come back over 31%. So we're not out of the woods yet. But I'm starting to see a little bit of a sell-off with the NASDAQ. And we've had an absolute run-up this whole entire year with the tech market. While a lot of dividend stocks and, defensive stocks didn't really do too well, they've been basically flat. So when I talk to people and they go, oh, my portfolio's like up like 3% year to date, I'm like, oof. It's because a lot of their dividend stocks have not been performing well, or they have like value stocks and they're basically flat. Yes, they did well last year when the tech market sold off and dividend companies paid like some of the highest amount of dividend payout ratios like in the history of mankind, because that was the time to invest in dividend stocks. And they were raising their dividends. People were like throwing so much money in these high dividend paying companies, trying to like be a little bit more defensive. And now it's like, hey, a lot of these dividend stocks are not doing so well because now the techs have come back. And a lot of people think we are back on a bull run. And it's hard to say because, who can really read the market nowadays with it? Whoever would have thought the market would rebound the way it did after bottoming out so much, right? And, a lot of people have invested into the NASDAQ. You look at the Dow and it's almost flat for the year. But you know what? It's green. That's all that matters, right? As long as it's going up. So on my end, I figured, if the market does become a little bit more volatile, given that it's August, we have September, October, November, December, we still have like 4.5 months left. I do think that if it does become a little bit more volatile, the S&P 500 would be a safe bet. That's just my opinion. And if the techs continue to sell off, so be it. We'll deal with it. But for the most part, three most defensive holdings in here, which a lot of people might disagree with, but I would say SPY, Merck, and Berkshire B. Merck has seemed to hold its weight fairly well, especially like last year when COVID hit and it wasn't doing so well. Um, I mean, it was up like 30% last year when the Nasdaq was down 30%. So uh, I do have a significant amount in Merck, and I do think they've just been a big player in the pharmaceutical industry. They've made healthy acquisitions. They have a healthy balance sheet, great fundamentals, and I know quite a few people who actually work at Merck. I'm like, wow, if you're hiring my buddies, like people I know of, brilliant people, great minds, probably it's probably a great investment, and it's pretty stable for the most part as a Dow stock. Not like Pfizer. Amgen's been kind of like a dog. If you don't know, I sold my Amgen. I've invested it all into SPY. I just feel like, you know what, just can invest into SPY, forget about it, type of thing. So yeah. But on that note, I hope you guys enjoyed this video. This is a great do over, great little reset of my portfolio. And like I mentioned before, it's really humbling to see this, at four figures, and we're starting over. It's like when I first started trading, and we'll just see how fast we can hit back up to six figures, and then we might just go from there. Might just start doing like quarter million. I'm really reaching out far here in left field, saying things like that, but it's great to reach beyond the stars. Not to sound corny, but you look at something like this, and sometimes it takes a nice little reset, like an account transfer or just sending money over to a different account and not looking at it, forgetting about it, and focusing on what you're most actively trading on. Now, I've never been like a big fan in selling options. I've never done it. I've played options for a little while during COVID, won a little bit, lost a little bit. In the end, I came out green, but it just wasn't for me, because I just didn't really, I'll be honest, I didn't really understand the full like technical analysis of like reading how to like play stock options. But luckily, I came out green. It might have just been luck and just timing. Um, but I don't play that anymore because it's just not for me. It's just I don't really enjoy it. I'd rather do something that I enjoy, doing more and I get to watch, and something that's a little bit less volatile. So right now we're sitting above 2,200 bucks. It's almost middle of August, and by the end of the year, I think maybe we can hit 20 grand. I think that's a modest amount. But we'll see. I'm just speaking. I'm blowing smoke here, because we don't know. Other than that, hope you guys enjoyed the video. Let me know what you guys think below. If you guys have any more stock picks, if you guys have any more ideas that maybe I could be investing in that I could take a little bit of take a look into, be a little bit more investigative into, I'd be more than happy to. I'm always looking for other stocks to invest in. I will mention though that since I am a little bit tech heavy, I might be a little bit more deterred from the techs because like you can only invest so much into techs, and if they're all moving in a very similar direction, you just I'm basically investing in like the big players here and a little bit in like the smaller players, which I might do a video on later on. But yeah. All right. Other than that, hope you guys enjoyed. Have fun investing, stay safe, and take care.